So let's say inside of your whole life insurance policy, you have $100,000. We'll keep it simple. You have $100,000 inside your policy. Most of the carriers that I work with, you're going to get a guaranteed rate of return on your cash value around 3%. Okay, so 3%, and then on top of that, like I covered earlier, you're going to get a dividend from the insurance carrier. So you're getting 3% plus dividends, and the net on that is going to be around 3 to 4%. Okay, because there's insurance costs and other fees you have to factor in to get your true internal rate of return on these policies. So it's going to be right around 3 to 4%. Some cases it may be higher over time, but we're going to be conservative here and go with 3 to 4%. So that's really important to keep in mind. So inside of your policy, you've got $100,000 in cash value, and you're earning, we'll call it 3.5%. We'll meet right in the middle. 100 grand in your policy, earning 3.5%. Now, if you want to go buy the car for $30,000, what you're going to do instead of paying for it in cash or getting a loan from a bank, what you're going to do is you're going to take a loan against your cash value life insurance policy. You're going to take a loan against the whole life policy. So you've got 100 grand in there. You're going to request a loan against 100 grand for, in this case, $30,000. The life insurance carrier that you're with is going to loan you the $30,000. Now keep in mind, there's going to be interest on that loan. There's no free lunch. There's no free money here. But the $30,000 loan you're getting from the life insurance carrier is simple interest, which is super important to be aware of. And the other thing with the loan that you get from the life insurance carrier is you have full control on how you want to go about paying that back to the life insurance carrier. So you're not bound to the terms that the life insurance carrier sets in terms of how you have to go about repaying that loan. So you have a lot more flexibility and control with these types of loans. And I want to go a little bit deeper on that, because if you get a loan from a bank, who's in control of the loan, you or the bank? Well, obviously it's the bank. They set the terms and you have to abide by that. With these life insurance carrier loans, you have a lot more flexibility to go about it. So you can pay the loan back exactly like, or let me back up. If you got a loan, if you were looking at getting a loan from a bank and you decided not to go with that and you instead got the loan with the life insurance carrier, you could repay the loan back to the life insurance carrier as if you were paying it back to the bank if you wanted to. And then you still have flexibility, like if you didn't want to do that anymore, you could switch it up at any point in time. So it's just important to be aware of your options and the ways you can go about repaying life insurance loans. So now getting back on track, I know I went on a tangent there, but it's really important to be aware of that. You have this $30,000 loan now at, let's call it 5%. We'll go up a little bit, 5.5%. That's pretty standard across the board. Some life insurance carriers' interest rates are higher, some are lower, but 5.5% is pretty standard around that. So let's say you have this $30,000 loan at 5.5% simple interest. You have the loan, you go use that money to buy the car in cash. So you use the $30,000, you bought the car in cash. Now you own the car outright. You now have to make payments back to the life insurance carrier to pay that loan off that you got from them. But meanwhile, while you were doing that or using their money, your full $100,000 in your cash value was earning 3.5% the whole time, as if you never touched the money. So that's the power of using a whole life insurance policy set up this way, is you can use it as a financing tool to acquire, whether it's a car or investments, and I'm going to dive into that more, but you can use it as a financing tool while your money still earns interest inside of the policy, guaranteed, plus the dividends. And that is so important to just wrap your brain around, is you're earning this, or this asset, this policy is guaranteed to appreciate over time. And then on top of that, you get dividends from the carrier, which is not guaranteed, but the carriers we work with have been paying dividends consecutively for over 100 years. And that's the other way to go about financing, and the way you can earn interest on the same dollar twice. So you're earning a guaranteed rate. To recap, you're earning a guaranteed rate plus dividends inside of the policy. So that's one area or one way you're earning money on your money. And then the other area, which I didn't cover this yet, is when you borrow against the policy and you use the money for an investment, and hopefully you're making a good investment where you can get a return, that's where you can earn money on the same dollar in another way. So you're earning interest on the dollar inside of your policy, and then externally on whatever investment you decided to make, and hopefully you're making a return on that. That's the power of this strategy. So that, I went deep on that because it's just so important to know, like, what are some options you have out there instead of the traditional way or traditional advice about going about your purchases in life, bigger purchases, cars, homes, vacations, weddings, things of that nature, and also investments.